This is not the petro yuan. This is not the petro ruble.
Mm-hmm.
This is not a gold-backed yuan. This is not a gold standard. This is not the end of the US dollar. It's not the end of the euro. It's not the end of the world.
Today, we're talking about the looming economic collapse that renowned economist Jim Rickards believes is on the horizon. This isn't meant to be a sensational claim, as history has shown us that the international monetary system can be fragile. The international monetary system has faced collapse 3 times in the past century, one in 1914, one in 1939, and one in 1971. Each time it led to significant changes in how the world's finances operate, and now we find ourselves on the brink of a potential 4th collapse. Jim Rickards highlights the fragility of a system that heavily relies on the US dollar, emphasizing that the dollar falters, the entire system may crumble. How do we get to this point of collapse? Jim Rickards suggests that it might not be a sudden catastrophe, but rather a slow progression driven by wishful thinking, denial, and delay. Instead of a catastrophic level event, we may just blunder into a collapse. This gradual approach may lead to executive orders and, in a worst-case scenario, a rise in social unrest. Contrary to doomsday scenarios, a collapse of the monetary system doesn't mean the end of the world. In the past, major economic powers have come together to renegotiate the rules of the game, so to speak. When the system crumbles, it prompts a reset, not a total breakdown. So, what can we expect in the aftermath of such an event? If a collapse were to occur, it raises the question, what would the international monetary system of the future look like? Jim Rickards draws a parallel to the new Bretton Woods-style conference. It's an opportunity for global leaders to restructure the rules that govern international finance. We'll explore what some of these new rules could be and how they might reshape the global economic landscape. Jim Rickards presents 4 intriguing scenarios for the post-collapse world, each with its own implications and challenges. Number 1. Multiple reserve currencies. In this scenario, the dominance of the US dollar diminishes significantly, and a multitude of currencies step in to fill the void. The euro, the Australian dollar, the Canadian dollar, and possibly others gain prominence as official reserve currencies. However, this scenario isn't a harmonious solution. Without a clear anchor like the dollar, it could lead to instability, as multiple central banks would have the power to influence global finances. Rather than reducing currency wars, this could potentially exacerbate them. Number 2. The special drawing right. Jim Rickards introduced the concept of the SDR as a potential solution preferred by financial elites. The SDR, or special drawing right, is a bit complex but fundamentally simple. It's like a printing press for central banks but on a global scale. Central banks can create SDRs, which can then be used for international transactions. This scenario would centralize control of the global monetary system, but it also raises questions about how this power would be wielded and regulated. Number 3. The gold standard. Another scenario worth considering is a return to a gold standard. Historically, currencies were tied to physical gold reserves, providing stability and trust. Reintroducing a gold standard could be the way to anchor the monetary system and reduce the risk of currency manipulation. However, this, as the other two, is not without its challenges, including determining the right value for gold and addressing the limited supply of this precious metal. And finally, number 4. Collapse followed by something worse. In this scenario, the collapse of the international monetary system leads to chaos and potentially even worse outcomes. It's a scenario where instability reigns, and there's no clear direction for the global economy. This situation could have severe consequences affecting not only the financial markets, but also people's livelihoods. Jim Rickards sheds light on the remarkable capabilities of central banks, particularly the European Central Bank and the International Monetary Fund. They possess the ability to print money, whether it's euros for the ECB or special drawing rights for the IMF. These SDRs, in essence, function as world money, as they can be generated in unlimited quantities to reflate and reliquefy the global economy. Jim mentions that the IMF has a publicly available 10-year plan to elevate the SDR to the status of global reserve currency. Implementing a gold standard involves grappling with several intricate questions. First and foremost is the definition of money. In the modern financial world, there are different categories of money, such as M0, M1, and M2, each with distinct technical definitions. To establish a gold standard, a clear choice must be made regarding which of these definitions will serve as the basis for the standard. Another critical consideration is the appropriate reserve ratio. Does every unit of paper money need to be backed by an equivalent value in gold, or can a lower ratio suffice? Historical examples provide some guidance, with England successfully using a 20% backing during the 19th century, and the United States operating on a 40% backing for most of the 20th century. These historical precedents suggest that a gold standard could be viable with less than 100% backing. it could result in the devaluation of other world currencies, creating a deflationary spiral. This situation would mirror the blunder made by Winston Churchill in 1925, when Britain returned to the gold standard. Thus, any new gold standard would require international cooperation and agreement among major economic players. A key factor in determining the feasibility of a new gold standard is the distribution of gold reserves among major nations. Currently, the European monetary system, comprising of countries that back the euro, holds approximately 10,000 tons of gold. The United States claims to possess 8,000 tons, and the IMF holds about 3,000 tons. Other nations like China and Switzerland also have significant but varying amounts of gold reserves. The distribution of gold reserves would influence the dynamics of any international monetary conference. Jim Rickards outlines 3 scenarios for gold price and a potential return to a gold standard. The first scenario envisions a global money supply with 40% backing, which would require gold to be priced at around $7,000 per ounce to support the money supply without deflation. The second scenario involves a global money supply with 100% backing, demanding a gold price of approximately $44,000 per ounce. The third scenario, a collapse, is the one that Jim considers the most likely, driven by various factors including wishful thinking, denial, and mismanagement of risk. Jim Rickards highlights a fundamental dilemma in the current economic landscape: simultaneous inflation and deflation forces. These opposing forces are exerting pressure on the economy, and their interaction is far from stable. He explains the dynamics of this complex situation. One of the deflationary forces is driven by deleveraging. When individuals or institutions are burdened with debt, they often need to sell assets to repay that debt. This selling pressure can lead to declining asset prices, causing a deflationary spiral. As assets are sold, prices fall, and more assets must be sold to meet debt obligations. This cycle can continue until prices bottom out, creating a period of deflation. Jim emphasizes that the balance between these forces is unstable. In the current environment, there is a notional 5% deflation and a notional 5% inflation happening simultaneously. These opposing forces are canceling each other out, but the situation is not sustainable. One of these forces will eventually prevail, and it could tip the scales towards rapid inflation or severe deflation. Monetary policy has 2 key tools to influence behavior. The first is negative real interest rates, where inflation exceeds nominal interest rates. This encourages borrowing, as borrowers effectively repay loans with less valuable dollars. The second tool is delivering an inflationary shock, which triggers a change in behavior. For example, promising 2% inflation but delivering 3% would create an inflation shock, prompting people to spend more and invest, thus boosting economic activity. Jim underscores the government's strong preference for inflation over deflation. Inflation allows the governments to tax effectively. For instance, if prices remain constant while income rises, the government can increase tax revenues. Conversely, during deflation, where prices fall and income remains stagnant, the government's tax revenue would decline. This asymmetry leads governments to prefer inflation, even if it may erode the purchasing power of their citizens. The complex interplay between deflation and inflation's forces presents a significant challenge for policymakers and central banks. Their efforts to balance these opposing pressures impact the economy and financial markets. Understanding this dynamic is crucial for interpreting monetary policy decisions and their potential consequence for the broader economy. As we navigate this intricate economic landscape, it's essential to stay informed and be prepared for the outcomes that may result from these competing forces. If you found this video helpful, then don't forget to hit the like button and subscribe to our channel.